How are you, folks? Enzo Di Costanzo, St. Peter's University, and today we're working on the fifth. Is it the fifth one? Yeah, the fifth personal consumption expenditure video. I think the last one in terms of the final exam, and then I'll make the exam up over the weekend. It's Thanksgiving weekend. It's the Friday or the Thursday night of Thanksgiving, and then we'll make the exam with maybe 25 questions or so, a couple graphs, a little bit of Excel, and that'll be the course. Okay. Okay, folks, we're here, and actually, this is one where we're going to be looking a little bit at as much of a micro case as you can with a company like Walmart. That's a big, huge company, right? It's bigger than a lot of countries. Walmart cuts profit outlook as it lowers prices to move goods. I mean, it says it all right there. So their earnings are going to be impacted by Walmart lowering prices itself, and then it says cuts profit outlook because it's still got to pay a higher wage, right? So the wages are impacted. The cost to drive those trucks into the Walmart parking lot, that's a higher there's a higher cost to bring the goods to the Walmart in Secaucus or North Bergen or Bayonne or wherever it is that you whatever Walmart you go to. And but people aren't buying because people are starting to be concerned. It says retailers said higher food and fuel prices are denting consumer spending. So if the consumer's got to spend more at the Exxon station, the consumer's got to spend more at the McDonald's or in the grocery section. They're not going to be buying extra sneakers or lawn equipment or a lot of the stuff. The bikes, right? There's a bike section at Walmart, if you can believe it. I'm laughing because I'm one of these people. I've been riding a bike. No, I don't want to say custom made, but a bike that's a bicycle. People who really ride bicycles, you go to a bike shop and they measure, and it's almost like a suit, right? It's got to fit you, kind of a thing. And I've ridden a bike like that since I was 14 years old or something like that. Quite a while, quite a number of decades. And I never got hurt, never hurt a knee, never hurt an elbow, never hurt any of that stuff. So always keep that in mind. Anyhow, so Walmart warned that higher prices for food and fuel were causing consumers to pull back, and that's a bad sign for the U.S. economy that's relied on a resilient household spending power, on resilient household spending power throughout through rising inflation. So yeah, so here we've looked at. I mean, the main models here are real personal consumption expenditure. That's the model that we started with. That was in chained or inflation adjusted dollars. Okay, and our last model that we're going to work on today, because we worked on we're not going to do the quarterly ones because we're sort of switching gears to, we're doing the monthly, we did the annual. I'm switching gears a little bit with the last four live classes. I might do the financial, and we might edit how many live. We might be swapping out a couple of YouTube classes for some of the live ones. I'll let you know. So yeah, we worked on 5, which was the real one, and then the nominal one is today. So 28 I'm sorry, 286. 285 is personal consumption expenditure by major. So there's just 2. There's the data, and then there's the US dollar change, and this has got to be in one of the tables somewhere, which is why I would do it and not worry about the percentage changes and all those. I mean, you could do a little experiment and see how these are different, but if they're not reported or used, obviously the more important one is going to be the one that's going to be based on the index or based on the real personal consumption expenditure. This is the nominal one, so we're just gonna go through the process of figuring that out as we go along. But we've been monitoring those numbers, and it says an ominous sign for this economy is relied on resilient household spending to power through rising inflation. So let's look just since we have the monthly numbers, which are a little more accurate than the quarterly or the annual numbers or something to that effect. Let's look at some of the top line numbers. Yeah, it's been here. Just and here, this might be something that this might be something that you want to just because I have to figure out the graph for what we're doing here. Yeah, so that's just the top line graph. I just graph the data just versus itself basically. Yeah, it's the trend is a little bit of a dip. It's pretty much at a positive trend. So we can make a couple graphs, and again, your graphing is never a bad exercise to work on your graphing. The country's largest retailer, which warned in May that it was stuck with too much unsold goods. On Monday, it said they was having to cut prices to reduce merchandise levels, inventory. At its flagship chain and the Sam's Club's warehouse chain, the markdowns will cause the company's profits to fall in the second quarter. So yeah, so it's costing more to get the bike in there and to get the oranges in there, and they're going to charge less just to move it, kind of a situation. So certainly that's going to impact that's going to impact profits, and that's bad. That's not good. Okay, that's not good. And then there's an impact when you're potentially looking at lower earnings, and here's the next domino to fall. It says the announcement sent Walmart shares down nearly 10% in after hours trading. That might be something else we could look at too. I'm saying I don't know if I'm gonna generate that necessarily in this because we would need the store data too, but really the personal consumption expenditure numbers, Walmart is a pretty good proxy for that number, or that number is a relatively pretty good proxy for Walmart because it's a big part of retailing in America. Certainly, that's for sure. Uh, but I'll tell you, you'd be surprised when you looked at you say, "Oh, Amazon, this, that, and the other thing." I've heard some of the global online sales numbers for Amazon. It's not as dominating as you think. I mean, in America, it's a big deal, but there's a global economy out there, and their numbers are not what you might realize, or not what you would realize, because Europe is a big part of things. China has a very big percentage of the retail market. Its own Chinese companies, European companies, and Amazon. You may not be able to send something. You know, in the Middle East or something like that, the Eastern Mediterranean or Malta or something, you might not be able to send something from Amazon to some of these places. That's also something to keep in mind for the people who are going to work internationally. So yeah, shares were down 10%. So let's take a look at this. Let's do Walmart, Yahoo Finance. Did I look up Walmart? Well, we're going to look it up now. Yeah, I did. Actually, I looked it up here. Okay. Whoops. We don't need any of this stuff. Let's do year to date. Yeah, when did this come out? This came out July. So June. Well, it was the end of, you had a bit of a dip there. And where was this? This was 156 in April. It's 152 now, but it was down to 130. So I'm saying if you had timed some things pretty good, you could have gotten it for 119 this year. Okay, so this is the graphic, or the share price for Walmart that's out in the world. Okay, so there were a couple dips in there, so you could have picked this up on the cheap. You really could have. Let's see if this is going to help us here. Yeah. Okay, that's year to date. Okay, so you can see. So even Walmart, so these stocks move, and a lot of it is based on these earnings reports. That's just something to keep in mind. So yeah, we didn't do too many micro things this fall, but in the spring that's going to change. And it says, in after hours trading and pressured other stocks, Amazon was down about 4%. Walmart's e-commerce rival is said to report its earnings later in the week, whatever that was. So July 25th is probably a Wednesday, I would suspect. It's a Monday, sorry. So, okay, this was on Monday. Like I said, we're just moving through this because the next one is about GDP. But again, Walmart is a pretty good indicator. I would say is one a proxy for the other? Well, how Walmart does is how personal consumption does. How personal consumption does. So you could say either one is a proxy for the other. Certainly, McDonald's is an important one. How Procter and Gamble and Visa are doing. General Motors. Then it says the warning casts a cloud over a week when a raft of global brands with multinational companies, McDonald's, Procter and Gamble, Visa, General Motors, are slated to update investors on their latest quarterly results and the outlook for the rest of the year. Okay, so they're going to be giving guidance on how they're seeing, and I'm telling you, investment banks, private equity firms, even I hate to say probably some of the government agencies, they've got a reason to sort of maybe slant what they say. But Procter and Gamble, they better know how the economy is going to look and what's going on, because it's basing their their lives, or their business lives are based on how well they're predicting what's going to happen, how many people to hire. And in somewhere in some of the videos that we've had, we spoke about UPS is hiring, and Walmart's hiring, and Target, and whatever, Sam's Club, whatever, maybe how many extra folks of those guys are hiring for the holidays, and maybe not as much. It's not as much or less. I think I've heard that on some of the news stations. And again, so predicting that, how good your outlook is and how much it matches because it goes to costs, it goes to expenses, it's corporate expenses, which influence profits dramatically. Inflation has been running near the highest levels in decades, and the Federal Reserve is expected to raise interest rates this week to fight the higher prices. Several high-tech companies have warned in recent days of slowing growth, and leaders of some of the biggest banking companies have cautioned the high risk of a recession. So the July meeting, January, March, May, then I think May, June, and July. So January, March, May, 3, June, the fifth one. I guess that's the fifth one, because the September one is 6, and then 7 and 8 are November and December. So Walmart said higher prices for food and fuel have hurt sales. Yeah, I just said that at the beginning of the lecture today. Apparel, which generates higher profit margins for the company. So yeah, so you don't need a new pair of jeans or new pair of sneakers or something. The ones you have are probably okay, and but you do need milk, eggs, 2 pounds of beef for meatballs. That stuff you need. Overall, the company expects comparable store sales, excluding fuel, for its Walmart division to rise 6% in the second quarter from a year ago. Okay, but the growth is coming from less profitable items, and the company is slated to give its full second quarter report in August, which again, we don't have that in front of us, but certainly I'm sure it was released. And it says, while U.S. employment is near um, U.S. employment remains near its lowest levels in a decade, consumer sentiment fell in June to its lowest point on record, a sign of concern because household spending accounts for 70% of U.S. economic output. Some shoppers, especially from lower income households, are trading down to economy beer and discount cigarettes as they feel more pressure on their pocketbooks. So I don't say that's luxury items, but things that they don't really need, not things that aren't necessities or discretionary spending. You don't need beer. We don't buy or use either one of those in my house, that's for sure. But again, the consumer sentiment, how people feel, what people's expectations are, what their confidence is. That's the whole University of Michigan survey that's been having data collected since the 40s, that kind of a thing. And it says most retailers are not struggling to grow their top lines, but they're struggling to maintain their high levels of profitability that were commonplace over the last couple of years. This is a global data, which I'm sure there's a retailing market research firm that gathers that data and does probably a very good job of that. Target issued profit warnings in June after it reported quarterly results, which, like Walmart, showed a surge in inventory levels. The big box retailers were caught off guard this spring as shoppers shifted their spending away from items that have been high in demand during the pandemic. The abrupt shift left many retailers with a glut of peak pandemic favorites, such as casual clothes, home products, that need to be marked down. Bed Bath & Beyond, the Gap, issued profit warnings also and replaced their leaders. Walmart in May reported inventories rose by 33% in the first quarter because it misjudged shifts in consumer spending. And these are companies that this is what they do, right? To try to judge this stuff. Executives said the higher cost of goods because of the inflation, as well as easing of the supply chain snarls, the limited supplies early in the pandemic, have also contributed to the excess inventory. Well, I went to my now that's not Walmart, my sort of local Italian grocery store, and they didn't have the dry ones, not the ones that are already made for you. The shells where you cook it in the water and then you fill it yourselves. They didn't have those. It's the Ferrara brand. I should look online to see if I could get them without. But you notice too, whenever you buy some kind of big stuffed pasta piece, you want to make sure that everything's not broken in there. So you if you're trusting the post office and UPS to get that stuff to you, you're rolling the dice. You might get a bunch of broken pieces of dried pasta shells in there. So Walmart, the retailers are trying to unload items when rising prices for gas and groceries have made some people rethink their spending. So yeah, right there. I mean, that's what's going on. That's what's going on. Okay, and that's from the retailer's perspective, which is why I wanted to go over this particular article. The increasing levels of food and fuel inflation are affecting how consumers spend. Walmart chief executive Doug McMillon said in a statement, and while we've made good progress towards clearing hardline categories, apparel in Walmart US is requiring more markdown dollars. Mr. McMillan said the company expects additional pressure on general merchandise in the rest of the year, including holiday shopping season, but said school supplies were selling well as families prepare for the new academic. This is over the summer, and says, and here's a big sort of microeconomic indicator or big accounting number here is Walmart expects its operating income, excluding units it's divested, to decline between 10-12% in the fiscal year ending in January. So the retailers end in January. In May, the company said it's expecting operating income for the year to decrease by about 1%. So, yeah, so it went from a 1% decline now to about a 10 times that decline. And then there was another estimate around 3 times. Okay, so you got to be careful. Well, for the year, yeah, it says you have a couple of them. It says Walmart expects operating income. Now it expects, okay, now, so as of July, to decline 10-12% for the fiscal year. In May, the company said it was going to be a 1% decline, and there was a previous estimate, whenever probably earlier in 2022, it was going to be a 3% decline. So anywhere you look, it's a decline, and unfortunately, a much bigger decline than we expected earlier in the year. Okay, so that's the Walmart article. There's another article here, and actually, I didn't open up my Excel, and I will do that right now. We didn't spend too much time on GDP in this particular course, but it's an important piece of the puzzle. It's under output, and again, last year I spent a little more time on this in my macro class, but I didn't spend as much time this time through. It's generally going to be the quarterly numbers. It's generally going to be something that's quarterly here. So let's take a look at this. It says U.S. consumers are facing higher prices on store shelves, but have benefited from robust savings during the pandemic and a strong job market. Okay, for the time being. The U.S. economy shrank for the second quarter in a row, a common definition of a recession. So these are the July numbers. Okay, these are the July numbers. July 28th. So this was a Thursday. Again, a common definition of a recession: housing market buckled, rising interest rates, high inflation took the steam out of business and consumer spending, which is the main statistic you guys has been studying for the fifth lecture now, for quite a number of lectures. Okay, and let's check that number. So we were at Q1 was 24. Yeah, this is nominal. You got to be careful. You got to be careful with the real one. Yeah, this is inflation adjusted. This is down. Yeah, they're both down. You can see this is 20 trillion. This is 19.9. This is 19.895. This is 924. So these are both negatives, right? They're both down. So if you look at this, this is the deflator. Yeah, this is the ratio of the nominal to the real is what that is. That's another inflation measure. And here's the percentage changes. These are both negative. These both didn't grow as much as it did in Q4, or certainly in Q1 and Q2 from last year. Okay, even though these aren't negative, but the overall number is negative. So the component pieces, exports, investment, some of the investment numbers could be negative, or dragging it down. So for Q2, investment, right? The net investment number was negative, and some of the pieces were negative here. This is in structures, so there's less investment in structures and some of these other things. I think the inventory number went down a bit, and a lot of the personal consumption spending is a lot of the pieces there are negative. Okay, so you're netting out to two negative percentages, and these were I think these were the most recent numbers. I mean, they can change a bit, so you got to be careful with that. That's contribution. So yeah, so here's the change from the preceding period, and this is gross. But these have to be the real numbers, right? Let's just check these. Alt TT, not the nominal ones. Yeah, that's the dollar change in real. So that's the inflation adjusted number, so those are both. So negative 82 billion, negative 28 billion. So you can see it in dollars, or you can see it in the percentage changes. Okay. So GDP is a broad measure of the goods and services produced across the economy, fell at an inflation seasonally adjusted rate of about -1% or so. Yeah, well, it's a little bit different, but okay. Followed by a 1.6% contraction. Yeah, so we have the 1.6 in the first 3 months of 2022. Um, the report indicated the economy met a commonly used definition of a recession, 2 straight quarters of declining economic output. So we have that. So the official arbiter of recessions, the Bureau of National Bureau of Economic Research, says a significant decline in economic activity spread across the economy for more than a couple of months, and it has to impact, or it's you have to see declines, more people or less people employed, declining output, declining, and all of that may not be true, even though maybe one of the indicators is negative for probably some arcane statistical reasons, but employment seems to be increasing, household income. Now, unfortunately, we didn't study income, but we can look at employment. Now, I know employment, uh, it was increasing, but it was increasing less, excuse me, less than it was previously. Not labor force, civilian, labor force, population. Yeah, here's non-farm is the general measure, and it sounds it's what it sounds like. Yeah, I mean, look, if you look in the summer, July, we added 500,000 jobs, 200,000, but added 7 in February. Now it's September's really now we're 200,000. Where we were, 400, about 400, 400, 400, 300, 500, 300. Now we're down to almost 250. So that is in decline. Okay, that is in decline. In terms of we're adding more people, sort of a slower pace. And some of these are just the monthly percentage changes. So this is the annualized number there. This is the month over month, or the change from a year ago, kind of a thing. So you can see that the pace of adding jobs is slowing. That's really what that should be telling you. And again, we really didn't hit that model in this particular course. It says whether or not the economy is in a recession, it's only a matter of time. All right, from inflation, equity markets, housing downturn is and again, we don't have I didn't go through the housing statistics right now, but it says it reinforces the feeling that it's only a matter of time before we're in a proper recession. So less housing starts, maybe less homes being sold, maybe the prices are a little bit lower, not as much demand for housing. So if you dig into those numbers, that's what you're going to see, and that's what they're saying here. Analysts noted there's that much of the decline in the second quarter was due to a slower pace of inventory restocking. Okay, because inventories have increased a bit, and you saw that from the Walmart article. That's what Walmart was saying, which is a very big piece of the retail puzzle for America. And again, we didn't go through the personal income numbers, but we certainly can at some point. So it says the U.S. is in a period of very significant fiscal drag. Uh, Fiscal drag. Well, are we spending less? Well, consumers are, but the government, I don't think is. But when you say fiscal drag, that's generally references government spending, not so much the consumer. But okay, she's a government federal employee for quite a while, so she uses that for even the consumer, I suppose. It says most economists surveyed by the journal expect the economy to grow in the third quarter and 2022 as a whole, although lately they've lowered their estimates. We're seeing a sharp and necessary deceleration rather than a recession. Says chief economist at Goldman Sachs, adding that slower growth is needed to rebalance the economy's supply and demand for goods and services, cool wage growth, and again, if you're looking at the wage numbers, let's see how the wage numbers behaved. So we're here, non-farm, private, government employees. Let's see the other direction. And again, I don't recall if we went through the price wage. I don't think we did the price wage spiral, but in terms of the month over month numbers, yeah, I mean wages were growing a 0.5%. Now it's a third of a percent or less, and year over year is 4%. Now it's down to about 3.5. Or pardon me, 4. Yeah, it's down from it was 5. Now we're down to 4.98. Okay, so again, so wages are even growing a little bit slower. It says the new figures mark a sharp pullback from the final quarter of 2021, where GDP rose 6.9% at an annualized rate. Let's check that number. Output. See, again, I have all this stuff sort of. Well, this is 7%. This is contributions. Yeah, 7. Oh, they're both 7 somehow. 2, 7, 7. Hmm. Yeah, these those are the contributions. Those are the contributions. Um, that was 7, and what did they say? Yeah, 6.9. So 7. That capped a year in which the economy recovered strongly from the effect of the pandemic-driven recession and best annual growth was 84 by low interest rates, roughly 6 trillion of government borrowing and spending since COVID struck. And yeah, that's a number. Fox News broke that down up into pieces. It's where all that money went and how much it was. It was partly Trump, partly Biden. It was the both of them. So took office a year ago, healed the nation. Well, that hasn't happened. But and boosting an ascent to economic recovery with massive assistance from Washington heading to the midterm elections in fall. Latest figures have put the White House on defensive about the state of the economy. Well, the voters spoke, and we'll leave that for another video. But I suppose people like high gas prices. They like high food prices. I guess the voters want that. I don't know how else to interpret it. Right? I guess the voters in this country, the New Yorks and the Californias and the Illinois and the Massachusetts and the Washington states and the up in Seattle and the Oregons and all these places in the Northeast want higher prices. They want inflation. Okay. So you voted for it, so you got it. And high inflation, weakening consumer sentiment, and and supply chain volatility. It says business, households, and policymakers. Yeah, I mean, those are the right. I mean, that's what we're dealing with, right? Weakening sentiment, supply chain problems, and more inflation. It's consumer spending, which accounts for roughly two-thirds of economic output, rose at a 1% rate in the second quarter, down from 1.8 in the first quarter. All right, let's look at those percentage changes. So we were down from 1 the first. Well, but again, these numbers are updated a bit, but this is the personal consumption number. Yeah, that's the personal consumption number. So those are numbers a little bit different. It says 1% in the second quarter and 1.8 in the first. Well, the first quarter is 1.4. Now it's up 1 point. So it's a little opposite to what they're saying there. But again, the numbers were updated from when this came out. Inflation hit a fresh 4-decade high during the second quarter, eroding Americans' purchasing power. The Federal Reserve responded by aggressively increasing interest rates again, and which in turn cooled the housing market, reduces brokers' commissions, and denting construction. The central bank raised rates Wednesday, and indicated more increases were likely. Yeah, this was Thursday. So that was the day right after that, whatever meeting that was, the fifth meeting of the year, I suppose. And then it says residential investment subtracted zero point 0.7 from the contribution was a negative 0.71 from GDP growth. Well, we got to find that a bit. Well, yeah, residential construction was down 17%. Right. So yeah, so these annualized numbers, the Q2 from Q1 down about 30 billion or so, 35 billion or so. And then in terms of the contribution, that contribution, yeah, down about the contribution is down 0.7%. And what are we saying here? Yeah, about 0.7, 0.7, 1.68. Business investment worsened slightly, and spending on structures and equipment declined. Okay, we looked at that already. Percent contribution is okay. So this is the data we just looked at our own data. That says the U.S. economic recovery is following the unusual trajectory, weakening output but strong job gains. So the unemployment rate, a key barometer of economic health, held steady at a low of 3.6% for the past 4 months. And we looked at that, I think, in previous videos. And then the employers continue to hire at a good pace. And the labor department said Thursday the new applications for unemployment benefits, a proxy for layoffs, held last week near the highest levels of the year, a sign that tight labor market is loosening. Well, let's go back and it says new applications for unemployment benefits, a proxy for layoffs, held last week near the highest levels. Then it says that's a sign that the tight labor market is loosening. Well, if there's more people applying for unemployment, how is that? How is the market loosening? I don't know how how is it? Yeah, these words tight and loose. What do people have to use more descriptive words because that's very confusing the way that's written. It says the Labor Department said Thursday that new applications for unemployment benefits, a proxy for layoffs, held last week near the highest levels of the year. Okay, so if people are applying for benefits, that means they're anticipating not working eventually. So, yeah, I guess it's loosening, I suppose, right? I suppose tight labor market means that employers are looking for people, but now they're not. But okay, like I said, the terminology here should be they're not math guys. They're definitely not or scientific guys who write this stuff. Inventories, the pace of restocking kind of from much of the decline in the second quarter, subtracting 2 percentage points from GDP. So again, these guys they're a little bit in love with the contribution piece here. Yeah, change in private inventories. It was minus 2%. Okay, so we have that. Uh, a shift in consumer spending away from goods and back towards services and rising prices cutting people's buying power left many companies with stockpiles of products that they're now discounting to unload. And again, we saw them in the Walmart piece. Yeah, we saw them in the Walmart piece, and it's going to say it again there. Walmart said on Monday it was having to cut prices to reduce merchandise levels at its Sam's Club and the main store. Manufacturers are still struggling with the pandemic-related supply chain disruptions. Business is a little unhealthy right now. Best Tool and Engineering Co., according to its president, Joseph Sherlock, the company based in Clinton, Michigan. Clinton Township, Michigan, makes tools and plastic components like welding fixtures for vehicle dashboards, and the nationwide shortage of computer chips. These automakers are pushing back orders. Yeah, this whole again, I really didn't study this whole this computer chip shortage. I used to that when I worked at Value, I was the Intel analyst, the applied materials analyst. I was the analyst for those kinds of companies, and I should follow that a little bit more than I actually do. So it says autos are waiting for chips, and we're seeing it down in the supply chain. And it says he's concerned that the economy is slowing. The 15-employee company has frozen equipment purchases and scaled back hiring plans. But the president feels uncertain about the rest of the year. So again, the guy running the company, and it's his business to turn a profit. It's his business to control costs. He's saying that we're having trouble predicting the next 6 months out, the next couple of months out. Trade provided a bright spot. Exports rose at a robust 18%. Let's check that. Yeah, well, there's 18 there. It says okay, so it says exports rose at 18%. Yeah, the export number's up here. Okay, it's about 50, it's about 14%, not 18, but okay. But it still rose as demand picked up for American-made goods and more international travelers returned to the US. Okay. It says some economists prefer to look at final sales, which I don't generally follow that statistic though. A subset of GDP that does include the often volatile category of inventories and trade, but to better gauge U.S. economic activity. Final sales fell at 0.3% of an annualized percent in the second quarter after rising 2% pace in the first quarter. Americans still have relatively healthy balance sheets. After the pandemic hit the economy, increased household savings, and I've looked at that last year. I remember seeing that number was far up there in some of my lectures a year ago. Government stimulus checks and enhanced employment benefits boosted household finances. The resulting excessive savings, the amount above what they would have had there been no pandemic, remained elevated. According to Moody's Analytics, excess savings totaled about $2 trillion. And again, we'd have to look at that number, but we could have looked that up. If we downloaded the data, we could have grinded out that model, very similar to the consumption model. But again, we're at the finish line of the course. So consumers are hunkering down. It's pulled back on discretionary spending like dining out, expensive salon visits to pay higher prices for basics like oil, electricity, grocery in recent months. Cat food has gone up by about $10 a bag over the past year. They're interviewing, the journal is interviewing a person, an individual who works for a retirement financial firm. The husband's car is 250,000 miles, with the couple decided not to replace it because of the current high prices. And it said in a different market, they'd be buying a new car right now. So that's very University of Michigan-ish survey question. What are you spending on, and how are you feeling about buying a new car, and how do you see the next couple months or the next couple years? What you think that's going to look like. I remember I was watching a documentary over the break about Reagan, not about Reagan, but it was about the Miami drug smuggling that happened in the 70s and the 80s. And Reagan got up there, and if it was Carter or Reagan, I think it was Reagan, says the people are disheartened by seeing that stuff. And again, we're talking a couple decades ago, so it's a different set of values, I think, from 1985 to today, that's for sure. But people were disheartened by seeing so much drugs come to the country. Now it's a different attitude towards things of that nature. So consumer confidence is down. So certainly from this, not buying a car where it has lots and lots of miles on it, pet food, how do you feel about those prices moving around? Then says the consumer sentiment index and the consumer confidence index try to measure the same thing, consumers' feelings. And again, that was the Michigan survey. And last fall we did a test on that. We had a test on that stuff. A couple of semesters ago. Okay. All right. That's the Wall Street Journal part of things. We talked about the BEA last time, and these were economic indicators that help predict market trends. So that'll be the next part of what we're talking about here. Walmart. We talked about Walmart. We talked about the GDP. And here's the 5 indicators: weekly data reports, monthly data reports, other important indicating reports, industrial manufacturing reports, and the Beige Book. Okay, economists typically group macroeconomic statistics under one of 3 headings. It's a leading indicator, a lagging indicator, or a coincident indicator. And we're going to go through the definitions of that stuff. Figuratively speaking, one views through the windshield, the rearview mirror, or the side window, I suppose. I get the economists love to use they love to use I don't say fancy terminology, but it's sort of that very literary terminology. So the collection of things that we're going to look at here, coincident and lagging indicators provide investors with some sort of confirmation where the market is and where it's been, and a good place to start because they help indicate where the market might be heading. So yeah, we need to look. So let's see, a lagging indicator, some confirmation where it's been, yeah, and coincidences. So, yeah, the side mirror and a leading indicators is what you okay, fine. And it's going to indicate where the economy might be heading. Okay, so in order for the economic indicator to have predictive value for investors, it must be current, it must be forward-looking, it must discount current values according to future expectations. Meaningful statistics about the direction of the economy start with the major market indices and the information they provide about it. So there's stock futures markets, there's mortgage and bond interest rate and yield curves, foreign exchange rates, commodity prices, gold, grains, oils, metals. So again, having some sense of where these numbers are headed, I think, can help you figure out meaningfully where the economy. And believe me, the president of Intel, the president of Walmart, the people who run these companies, the Walmarts and the McDonald's and the Exxons and the Best Buys or whatever it might be, they should be up on these. I hope they're not just running to New York and having expensive dinners on the stockholders' dime, right? That they're running out and and studying these trends and trying to figure out how to position their companies and where to deploy assets. That's where to employ labor, where to employ capital to maximize earn the earnings of the company, which is what running a company it's supposed to be, right? These measures are crucial to investors. They're not generally regarded as economic indicators per se because they don't look very far into the future. So a few weeks or a few months at most. So trying the history of indices over time puts them in the context and gives them some meaning. So for instance, it's not useful to know that it costs $2 to buy a British pound, but it may be useful to know the pound is trading at 5-year high. So so in other words, you need to compare. And I remember there was one of the old timers of Value Line told me that long ago. He goes, don't just look at a number in an absolute manner. Look at it as a comparison. So here, one that we're all very familiar with, obviously the changing population of the country, 330 million people, and in Biden's years in office, it's most likely going to change by a good 1%, maybe 2%. You might be looking at 10 more million, another 10 million people. Well, maybe not. Okay, maybe 0.5%, but you're looking at another. So yeah, 30 million would be no, 30 million is 10%. Yeah, 30 million is 10%, and um, 3 million would be 1%. And if we're looking at 10, so yeah, we might be looking at a 2.5, 3% change in the population of this country. So to sit there and say, well, there's X number of people, streaming in, through the borders or whatever it might be. But again, you want to compare that to now, if this was, an island nation with 500,000 people somewhere, if it was Malta, right, that has like 50,000 people or 75,000 people, whatever it might be, or no, maybe it has 500,000 people. But anyway, it does. I don't think it has a million people. I don't think it does. That would be a big deal. And those islands in the Mediterranean they're not set up to manage that. So there's weekly data reports, unemployment insurance, Department of Labor puts these out, what the money supply is. Okay, it says in weakened economies, so unemployment filings will trend upwards. They're generally analyzed on a 4-week moving average in order to smooth the week-to-week variances. However, the report is a built-in bias and that self-employed persons, part-timers, and contract employees who lose their jobs don't qualify for the benefits and aren't counted. So it's not all encompassing, this whole weekly unemployment insurance claim. The, the money supply is an abstract technical calculation as how much money is sloshing around the economy. The Federal Reserve releases this number, and the digital world in which vast sums of money can be transmitted across the globe in an instant. The indicator's lost much of its importance over the last 10 years or so. Indicative. So this is indicative weekly reports. Then there's indicative monthly data reports. New residential construction, housing starts. Right, the Census Bureau puts it out. The Department of Housing and Urban Development. The report breaks out building permits issued, housing starts, completions. It's an important leading indicator that construction activities picked up in the early expansion and whatever part of the business cycle that you're in. The National Association of Realtors, existing home sales, they put out existing home sales where the housing starts reports focus on supply. This report focuses on demand. Okay, so yeah, so you have a realtor and National Association of Realtors looks at the demand side, and then the housing starts folks look at the supply side. Look at construction. Together, the two assess the overall health of the housing sector, and the data contains in this report is typically 2 months old, owing to the length of time involved in closing home sales. It's useful in predicting consumer spending and directly affected by factors such as mortgage interest rates, seasonal nature of the real estate business. Okay, so this is all really good stuff in there. But again, next fall, I keep saying it, but some fall I'm going to expand the housing statistics. Then it'll be at the expense of personal consumption expenditure. It'll be at the expense of the United States Department of Commerce data, that kind of thing. Then here's the Michigan survey, or this is the Conference Board. I looked up who this was. It's like the University of Michigan survey. Consumer Confidence Index measures respondents' perception, attitudes. It's not so exact and precise, but surprisingly accurate in projecting consumer spending, which accounts for about $7 out of $10 in the economy. The Michigan survey's been around 80 years or so. We like that one. And there's some other reports here: Manufacturing Business Outlook, the Institute for Supply Management, long-term mutual fund flows. Okay, so obviously for this one, is for the Institute for Supply Management, formerly the National Association of Purchasing Managers, focused on manufacturing. Wall Street watched it closely, given it's got historical reliability in predicting the growth of the GDP. So as this indicator moves, the PMI moves along, you can somehow predict the gross domestic product. And this, I don't know if this is monthly or weekly. This is Manufacturing Business Outlook survey. Okay, and I don't know if it's how often. So it's a month, month. Yeah, this is monthly. So this is most likely monthly also. Okay. The mutual fund flows, again, I've taught that in courses in the past. It's measured by the Investment Company Institute, or I'm sure the Federal Reserve, the central banks have to measure this. The indicator aggregates the net flow for stock, bond, money market funds, but it's largely ignored for several reasons, including that the report omits individual stock purchases and sales and does not differentiate between systematic investing, 401k, and market timing actions. So, in other words, if there might be automatic purchasing of shares, it doesn't distinguish between speculation, just sort of the individual going out there, or a specific pension fund pursuing opportunities in the market, and just automatic, the sort of the pre-programmed buying of equity by again 401k contribution systems and setups. It's a contrarian indicator that many individual investors react to events in effect, by buying and selling, by buying high and selling low. Okay, the money market fund flows reported separately. Yeah, the Federal Reserve has that. I knew the Federal Reserve had the durable goods manufacturing shipments, durable goods orders. That's in terms of the industrial and manufacturing reports. It's a barometer for the health of the heavy industry, including survey of manufacturing goods with a life expectancy of more than a couple of years. The purchase by business signify capacity expansion, and sales at retail suggest a rising consumer confidence. High month-to-month volatility requires the use of moving averages and year-over-year comparisons to identify pivot points in the economy. So yeah, so you'll learn a lot about statistics as you start to measure this stuff and these moving averages and what deviation really means and variance. You'll learn that stuff if you really get into this. The factory order report comes from the Census Bureau. It's more detailed and less timely than the DGR, which is the previous one. This is the durable goods order. The main shortcoming is that it fails to account for price changes that can greatly affect the inventories during both inflationary and deflationary times. And the report contains data for 2 months prior to the release, making it another leading from the rear indicator. The Beige Book is a summary of commentary on current economic conditions by the Federal Reserve. It's released 8 times a year. It's a collection of discussions from the 12 Fed districts, along with a summary statement of all which is presented in the non-committal measured tones, such as Fed speak. Analysts and investors attempt to discern the meaning of the report, much like the reading of the tea leaves. The report foreshadows Federal Open Market Committee actions at the following meeting, although the bond market predicts these actions with a statistical measure of virtually foolproof. So, yeah, so the behavior of the bond market, I guess, is predictive of what the Federal Reserve is going to do, but also the Federal Reserve says what they're going to do now much more freely than they did decades ago. That's for sure. So the bottom line is the indicators can give an investor a sense of where the economy is headed, and in the future, paving the way for investment strategies that will fit the future market conditions. Leading indicators are designed to predict change in the economy, but they're not always accurate. So the report should be considered an aggregate, and each has its own flaws and shortcomings. And this is something where, if you get into doing this for a living, you're going to follow this stuff a little bit closer than sort of the common person would. Okay, so we don't need this any longer. And what we're going to do, we're going to fill in that last table, and then I'll dream up uh, for the final exam. We're going to, you have to make some graphs, and we'll I don't know if we're going to do that in this particular video, because I think we've packed enough into this particular lecture as of now. So yeah, these are the monthly numbers here and the dollar changes. That's all. We're just going to fill in two tables, and that'll be it. So you go to the BEA website, and again, hopefully you've gotten some comfort with doing this. You go to tools, interactive data, and you go to the first national data here, then interactive data tables, right? 285, which is here, personal consumption by major product type. There you go. And you're going to modify this to 2019, refresh, and then you download into Excel. Now, this is something where you're going to be adding up some of the numbers. So what you can do is you can just latch onto durable goods right there and do durable goods, undurable goods and services, copy right there, paste just the values and hit escape. Goods, you're going to sum the bottom two lines, and then the top line number, you're going to sum services and the durable goods. You can take these copy and you go all the way through as far as your data allows you, Alt HV formula, then hit escape. So like I said, so yeah, again, in previous videos, we've gone through the formatting, right? Remember all this, the formatting, accounting, dollar sign, alignment, font, bold, okay, or change the font to blue. You've got to learn how to do all those kinds of things. It's you got to control your formatting. You have to. Okay, 14 trillion 89. Yeah. And the recent numbers are 17 trillion 607. Yeah, 17 trillion 607, 17,494, 17,398. Yeah, we're adding up pretty good. That was the data. And now there's other stuff here. You're gonna again, you're gonna go into the section here. And again, this is PC excluding food and energy, market based. So what do we have? We have the first three. So 1, 2, 3. You gotta paste just the values. Okay. I think we dealt with this. We added these two up and or added the three of these, right? I think we tried that somewhere. Italics, make it smaller, and the font, make a black font out of that. Equals sum. Yeah, it's close. All right. Yeah, that's pretty close. I blew through a couple borders here, so let's just fix the borders. Left border. Left border. Border. All right, so we did our check. Did you want up here with that? Yeah. Pretty close. Not it's the real was off a bit more because these are the nominal ones. What we're working now is nominal. We're here. Okay, so and then we have the market base. Again, there must be some sort of other methodology where these are worked on. So I think I may have said that to you guys in class a number of times. So the this thing paste values. Okay. Have all your data dropped in there. The next piece of this, we're going to take the dollar change from the previous month. You could do it in a couple different ways. You could take the component pieces, right? And then you can just sum. You can have the same two formulas here, right? Where you're summing the pieces up. Voltage V formula, right? And then do a same. And just delete out everything else that you don't need. The addenda, don't worry about the addenda. All right. Those are all the pieces there. These are just summations, or I mean, the differences. Alt HE formula. Okay. That's pretty much what I wanted to talk about with you guys. Okay, so you finished all the tables. Okay, so all the tables are finished up. You have the nominal one, and actually, what we can do, I usually put them in the same thing, but this is 14, right, and it's right to the top here. Yeah, see, it's gonna be more. This is 13, right? So the real personal consumption is about 13. Now that it's about 14, but you go down, so 14.2, 14.3, 16.7 to 17. So the nominal one is so this is not inflation adjusted. Okay. And like I said, so for the final exam, we'll do something where I don't know. I was thinking of doing we could do something where but yeah, the annualized percentage change, you have the year over year. You could compare these that top line to this top line and see how they're different. The year over year percentage change of the index and the month over month percentage change is annualized. I think that might be something that we might do. And then similar with the personal consumption expenditure, we have the real version, the real top line number. You have the real top line number, and then you can have the nominal one. So yeah, that might be it. And again, we've done so many graphs with you guys. So you should be able to make some graphs. All right, might do just a graph of these. So 285 and 286, and then the percentage, the inflation index. Okay. All right, folks. So our fifth and last video, we'll get the final exam questions out to you guys, and good luck with it.